Today we're going to be talking about HFX strategies specifically. The purpose of this video series is to provide an overview of the HFX strategies taught by the IM official educators and to help you improve your trading success. We will be covering the associated indicators of each strategy and how to use them. As we begin, it's important to remember the 3 steps to trade success. Step 1 is to identify if price is consolidating or trending. If price is consolidating, we want to look for trade entries at the top and bottom of the consolidation range. If price is trending, we want to look for trade entries in the direction of the trend. Step 2 is to confirm your trade idea using the indicators provided within the strategy. And step 3, we enter the trade in the appropriate direction, a call option if we're predicting the price will go up, or a put option if we predict the price will go down, with a trade time expiration of either 3 candles or a time given by the IM official educator. To identify whether the market is consolidating versus trending, we need to identify different pivot points in the market. And as you can see in this example on the euro to US dollar, you can identify put and call options at the top and bottom of the price consolidation range. And once price breaks out in a given direction, either up or down, we can then look for put options in a downtrend or call options if we're in an uptrend. Cash-Trap 2.0 is heavily based upon the first step in our 3 steps of trade success, which is to identify if price is consolidating or trending. If price is consolidating, look for trade entries at the top and bottom of the consolidation range. Within Cash-Trap, we want to look for arrows at the top and bottom of this consolidation range. If price is trending, we want to look for trade entries or arrows in direction of the trend. We do this by utilizing a tool called a currency strength meter. If you type this into Google, you will find that there are many versions of a currency strength meter. Each has its advantages and disadvantages, and for the purpose of this video, we will illustrate 2 of them so that you know how to apply them within the Cash-Trap strategy. Each currency strength meter takes 2 currencies and then combines them into a pair so that you can compare the relative strength of each against each other. And that will help to determine which direction the trend will be. In this example, on the left side of the page, US dollar is rated as weak. The Japanese yen is rated as strong. When the first currency in the pair is weaker than the second, we are likely going to see a downtrend. The higher the contrasting strength between the 2, the stronger the trend. In the example on the right side of the screen, the US dollar is rated as strong and the Japanese yen is rated as weak. In this case, we would likely see an uptrend. One of the common currency strength meters can be found at this particular website. We do not endorse them, but are simply using them as an example within this video. They measure the strength of each individual currency with a certain number of bars. The more bars a currency has, the stronger the pair is rated. So in this example, the British pound has 6 bars. That means it is stronger than the rest of the currencies in this list. The Japanese yen, which can be seen all the way to the right side on the top row, only has 1 red bar. That means it is very weak at the present time. So if we compared the British pound and the Japanese yen, the British pound is much stronger than the Japanese yen is at this present time. And because it would be listed as the first currency in the pair, in other words, GBP to JPY, we would likely see an uptrend situation. The opposite would also be true if the second currency in the pair had more bars than the first. This can be illustrated with this little diagram. Here we have 2 weight scales, and if you imagine each bar as a weight that goes to each individual currency, you can get an idea for the general trend direction. On the left side, the US dollar has 4 bars and the Japanese yen has 1. In that case, there would be more weight on the left side, causing the general trend direction to go up. On the right example, the US dollar only has 2 bars and the Japanese yen has 4. This indicates that there would be more weight on or strength on the Japanese yen side, indicating that the general trend direction would be in the downward direction. The way we apply this then to Cash-Trap is we then look for arrows simply in favor of that trend. you will get arrows that are opposing the overall trend direction. But when we first identify if a currency pair is in a strong trend, we can then favor arrows in direction of the trend, and we're going to increase the overall probability of winning those trades. Now that we've covered the 3 steps to trade success, and we've reviewed the importance of identifying either a consolidation phase or a trending phase, let's dive into the cash trap strategy, which is found on hourglass.im. So if you log into hourglass.im and come up to the strategies tab, you'll note that there are 2 different strategies, Blue Gator as well as Cash Trap. In this video, we will be covering Cash Trap exclusively. Within the Cash Trap strategy, we have several technical indicators that you must understand. Now, as we begin, it's important to note what time frame chart that we are looking at. You can see here in the upper left-hand corner of your screen the number 5 and 5M. That indicates that you are in a 5-minute time frame chart. This is important because we typically utilize a 3-candle rule for our HFX trades. For a 5-minute time frame chart, we will use 3 candles or 15 minutes as the time expiration for our trades. Over on the right, we have the alert panel, which, as you can see, refreshes automatically to give us new potential trade opportunities based on each currency pair. It will tell us how much time has passed since it called out this potential trade opportunity. Now, let's talk about the technical indicators that we are working with. We have several on this strategy. The first several are the Bollinger Bands. You can see these 3 red lines, 3 kind of orange lines, and then these 3 green lines on the bottom. All 3 of these are basically 3 Bollinger Bands. A Bollinger Band is a combination of a middle moving average line, we refer to that as the mean line in statistical terms, and the top and bottom lines are 2 standard deviations from that mean or middle line. And ultimately what this means is that over 98.3% of all price movement activity, all of these candles, will occur between the top and bottom lines. This particular indicator is very useful, especially during times of consolidation, as we can see here when price bounces up and down in between the Bollinger Bands repeatedly. It becomes slightly less useful during a time of trending, but we have other indicators to help us to know how to take the trades during a trending time. So let's review that now. In addition to the Bollinger Bands, we also have this purple line, which is a 200-point moving average line. This is our trend line indicator. What that means is that when all of these candles are below the 200-point moving average line, price is said to be in a downtrending direction. If the candles are found above that purple line, such as in this example here, price is said to be in an uptrending time, and we want to look for call options. Put options when it's below, call options when it's above. In addition to these indicators, we also have the stochastics indicator, indicated by this black plot line that oscillates up and down, and also includes the red dashed line at the 80% mark and this green dashed line at the 20% mark. We also have the RSI, or Relative Strength Index indicator, that also includes a black plot line that oscillates up and down, and then a fixed red dashed line and a fixed green dashed line at 70 and 30% respectively. With each of these indicators, we can use them at different times and in different combinations in order to identify good trading opportunities. Initially, by simply identifying whether we are in a consolidation phase or in a trending phase, we can then know which indicators will help us best to identify a potential trade opportunity. During a state of consolidation, such as in this time here, all of this price movement occurs with a relative top and bottom to each of the waves. And this is further noted by the lower and upper Bollinger Bands. And we can know where the price comes up to as where it comes down to. And we can look for potential trade opportunities during that consolidation phase by confirming the stochastics and RSI indicators with a cross through of either the bottom green dashed lines or a cross down through the upper red dashed line. So during a state of consolidation, when the price is near the upper Bollinger Band, and we have a cross down of the stochastics line here, indicated at that point, as well as a cross down of the RSI line through the red dashed line, we can then consider taking a put option for 3 candles, or some educators recommend 3 minutes with up to 2 rollovers. But in each case, during a state of consolidation, you can look for put options when price is near the upper Bollinger Band, and once you get a cross down of the black plot line down through the red dashed line on both the stochastics and RSI indicators. The same is true when the price is near the lower Bollinger Band, and you get a cross up of both the stochastics and RSI indicators. You can consider a call option, either for 3 candles, or you can start at 3 minutes with the ability to roll over up to 2 times, depending on the educator recommendations. Now, during a trending market, our strategy changes slightly. The Bollinger Band no longer serves as the main point of resistance to the price. And you'll note that during a trending time, all of these candles tend to hug the Bollinger Band the entire time, and they don't reverse and go in the opposite direction. We also disregard the cross up of each of these stochastics and RSI line during that time, because most of those cross ups will occur simply during a very short-lived time of retracement. And so instead, we employ a slightly different trade entry reason in order to take advantage of the trending time in the best way possible. That can be seen here. So once we have confirmed that we have broken out to the downside in this case from our previous state of consolidation, indicated by this large red candle here. And let's delete some of our drawing lines just so that this is a little bit more clear. So we have here the previous floor to this consolidation phase where price was waving up and down repeatedly. Once we got this large red candle and price came all the way down to here, we then had a blue candle indicating that the price was retracing back up to retest this previous floor, which has now become a ceiling. We then look for a confirmation candle. In this case, because we are in a downtrend with an initial breakout in the downward direction, we're going to look for this red candle here. This becomes our confirmation candle. At that point, at the close of that candle, we can place a put option for 3 candles. We can count them 1, 2, 3. This candle closes at this point, and we're clearly in the money that entire time, and we win that trade. Again, we placed a put option predicting that the price would go down. When we're doing this, we disregard these cross-ups of the RSI and stochastics indicators. Once we have an additional retracement candle, which is this blue candle here, and then followed by a red candle indicating that price is now moving back in the downward direction, we can place a put option for an additional 3 candles. And we simply count 3 candles, 1, 2, 3. The candle closes at the top of this blue candle, which is below our entry point. It's very close, but nevertheless, it closes below and we win that trade. Now this blue candle acts as an additional retracement, confirmed further by this red candle here, which is our confirmation candle. At the close of that candle, we place another put option. And then we count 3 candles. 1, 2, and 3. This candle closes right at or very close to, and we will consider this one to be a loss when it's that close, and that's okay. Whenever we're trading in a trending direction or in any given strategy, some losses are to be expected. After this blue candle here, which is our retracement candle, we get an additional candle in favor of the trend. And we place our put option at that point. We count 3 candles, 1, 2, 3. This is a red candle, which means that the price closes at the base of this red body, which is clearly below our entry point, and we win that trade. And you can continue to do that same simple strategy over and over again as long as the trend continues. Now, once you see that the price begins to cross over the middle mean line of the Bollinger Band, typically that indicates that price is losing its downward strength, and it may begin to go back into either a state of consolidation, or the trend may be changing altogether as it does here, and we then move into an uptrend situation. Now, one other useful thing that we can use as part of this overall strategy is this purple moving average line. This is a trend following indicator. It's 200 point because that means that they calculate 200 of these price candles in the calculation of this plotted line. And when price is below the purple line, that means that we are in a downtrend. When price is above the purple line, we're in an uptrend. So we can simply follow that same strategy in reverse. When price goes into an uptrend, we simply look for a retracement candle with a confirmation candle in the favor of the trend, and then continue in the upward direction. Now, please note that we also have the ability on certain brokers to roll over trades. And so if you find that you're not in the money within the first 2/3 of your trade and you happen to be on a broker that does have the rollover option, you can roll over for an additional 3 candles, which will buy you the time needed in order for that trade typically to win. But you want to use those with caution and based on the recommendations of the IM official educators. So that is the cash trap strategy and how to use it. Again, you want to look for the crossovers of the stochastics and RSI plot lines, either down through the red dash line or up through the green dash line during a time of market consolidation, as we see during this phase here. But once the market begins to trend, these cross-ups will give essentially false signals and will not result in wins because the overall trend strength is working against you at that time. Now, occasionally you might get a cross down in favor of the trend, as we see in this case here on the stochastics line, but mostly we disregard what the stochastics and the RSI lines are doing if we happen to be in a strong trending time. But we still need an objective trade reason on when and why to get in these trade opportunities. And if you follow what we do here, as you can see plainly on today's chart, this wins many times over. And it is very objective and helps cut emotion out of your trade strategy.